going on, everybody? Nate here with New View Trust Company, and welcome to another Wednesday webinar. I want to thank everybody for joining us, not only today, but the last previous weeks. You guys are watching our videos and sending us a lot of good feedback, so we appreciate that. And we're going to continue to give you guys great education from the #1 source for self-directed IRA education, and that's right here at New View Trust Company. Today, I have a very, very, very special guest who we're going to just dive into almost immediately because I'm really excited to hear what she has to share. And it's all around the topic of due diligence when note investing. What's the reason you should listen to our guest, Jane Wabs, is because she is not only a full-time investor, a note investor. She has experience in real estate, but she's also a licensed CPA. So she comes with a lot of knowledge from different areas that will help you, the investor, make better investment decisions, especially when it comes to note investing. So we're going to jump right into it. Before I introduce our special guest, I will say, just as our disclaimer, remember, New View Trust Company is a self-directed IRA custodian. What that means is we allow our clients to choose their own investments. What that also means is we don't sell investments to our clients. So that's different than your Fidelities or Charles Schwabs, who are licensed securities brokers. We are simply a custodian that allows you to hold alternative assets, alternative investments, such as note investments. The key is you are the one that has to find those note investments, and you as the IRA owner also has to do the due diligence on those investments. So the best thing about a self-directed IRA is you get to pick the investments. The worst thing about a self-directed IRA is you get to pick the investments. So the best investors that we see are the ones that have the most education, that are most knowledgeable, and these webinars are geared to help you gain more knowledge without selling you actual investments. So I want to bring in our guest speaker, Jane Wabs, who is the partner, investor, and real estate manager at Paper Profits LLC. She has a wide array of knowledge, especially when it comes to taxation. She's a big fan of self-directed IRAs, as am I. So we're going to talk about not only note investing, but note investing within self-directed IRAs, the advantages to doing that, but most importantly, the due diligence that one should do prior to buying notes within your self-directed IRA. So I want to introduce Jane. Jane, are you there? Can you hear us?
Yes.
Jane, thank you so much for joining us today. We had a great conversation prior to getting on, so I'm really excited. I've seen your slides, and I love the presentation that you're going to give. A lot of good content. And for those of you who are viewing out there, we're going to do a Q&A after the presentation. So just keep your questions. You can actually type them into the chat box, and we'll get to those at the conclusion of the webinar. So Jane, I will let you take it away.
All right. Thank you, Nate. So I'm going to share my screen. Can you all see it?
See it.
All right. So before I start, I want to say good afternoon, everybody. And I'm very happy to be with New View Nate today. Before we go deep into the due diligence on note investing, I do have a little disclaimer or disclosure. This is not an offer to sell securities. And this is just for our educational purpose today. We're doing an educational webinar, and we want everybody to be educated on note investing. So a little bit about me. I came from China. I grew up there, and I came to the United States in 1997 to go to grad school. I have a master's degree in accounting from San Francisco. I currently live in Orange County, California, beautiful area. I am a licensed CPA, as Nate mentioned before. I am inactive, but I am a licensed CPA. I'm passionate about financial freedom, as most of us are. Currently, I manage 2 investment funds, which we buy notes for the benefit of our investors. My partner, Joshua Andrews, he is the author of Paper Profits book. That book was published in 2017. We have, I have our contact information here. At the end of my presentation, I will show this again. So you will, if you like my presentation today and you want to get in touch with us, you can definitely do so. And I will I will also have a link to the book offered to you at the end. So before we get deep into due diligence on note investing, I do need to cover some of the basic concepts about notes and mortgages. What is a note? A note basically is a promise to pay from the borrower. You sign a contract, you agree to pay. A mortgage also sometimes is called a deed of trust, is a document securing a lien against the property for the lender. So when we do note investing, we are the lender, and the borrowers, they sign the note and the mortgage with us, and they promise to pay us on a timely manner. What are the basic notes? What are the types do we have? You often will hear people talk about first lien mortgage, second lien mortgage. Sometimes there's third and fourth lien mortgage as well. There's performing loans and non-performing loans and reperforming loans. The first and second, basically just the time, whether you recorded the first or whether you recorded second, that's the position of your lien. And a performing loan, meaning the borrower is paying as agreed. And the non-performing, then just meaning the borrowers stop paying. And normally the loan is 90 days or more behind. A reperforming loan is something that it had an issue, it had a problem before. The borrower stopped paying for a while. Sometimes we do a loan modification, or sometimes the borrower reinstate the loan. And so they start paying again. So that's a reperforming loan. People invest in notes. They could invest in commercial, multifamily, or there's also auto loans, student loans, unsecured loans. But our focus is on residential single-family homes. The reason is just we feel that's the most secure asset category, and we like it. Where do the notes come from? They could from banks. Most of, vast majority of the notes are generated by banks, whether big or small, or credit unions. Sometimes individuals will generate their own loans as well, such as, if you do a lender financing or seller carryback, that will be from our individuals. And sometimes we do private lending, also called hard money lending. Those loans are very short, most of the time are short term, like 6 to 24 months. And the rates are normally higher than the bank rates, but vast majority of loans are generated by banks. And all the loans we purchase are generated by banks. So why do we want to do note investing? What's the good about investing in notes? I am a CPA, as I mentioned before. Investing wise, I'm very conservative. I invested in real estate. I still invest in real estate. So the great part about note investing, it's a combination of real estate and paper. The great, why do we want to invest in real estate? Because it's a real property and it has the security. So when we invest in notes, we're using the real property as the security, as the collateral. The other reason is because when we purchase notes, we always purchase at a discount. So that also generates more cash flow, more return for us. And most of the time, the note investing is passive, unless you want to get into non-performing loans, then that can be active. So you buy a note and you just watch the borrower make payments every month. So it's very, very passive. And it's something that involved in real estate, but without the real property hassles. You know, I often hear people talk about being a landlord and all the problems, you know, the flood involved and plumbing and fire and, you know, you don't get to being a note investor, you don't get into those issues because you are not the homeowners, you are not the property owners, you are the bank. I think this note investing, this is a great opportunity. It's passive for our self-directed IRA investors. If you have account with NewView, the process is quite simple. So before you make a purchase, I would say you need to have certain criteria. What kind of notes do you want to buy? I'm going to list some of the things that we look for when we make a purchase, so you can use that as a reference. We always look for large equity. We prefer 80% or lower combined loan to value. The borrower needs to have a strong payment history. What that means is a lot of loans we purchase, they're in the reperforming loan category. So the borrower had issues before, they stopped paying the loan for a while. So we want to have evidence or proof that they will continue to make the loan payments. So what we are looking for normally is the 6 to 12 months consistent payments. The other thing we look for is the down payment. We would like to have a nice down payment from the borrower, whether we purchase a reperforming loan from somebody and then they made to the seller before, that's very good. What that means is just the borrower has skin in the game. You know, they've already put in a large down payment, but the amount of down payment they put down, it depends on the size of the loan. So, you know, if it's $100,000 loan, you may want to have a 10,000 down payment, but if it's just a 20K loan, then you may have a 2,000 down payment. So it depends on the size of the loan. You want to buy at a discount because that gives you some leverage or a little bit more return on your money. What that means is just you pay less than what the outstanding unpaid principal balance is. The other thing we do is we want to diversify. So we are a small note fund, so we don't have a lot of assets, but we have about 200 loans in our portfolio. I don't want to see that our investors put their whole life savings into one asset. Although this is a very secured asset class, but things could happen. You know, a loan could go sideways. So if you have everything in one loan, that can be very risky. The last thing I think for a self-directed IRA account is to reinvest your earnings and to compound your yield.
Jane, can I add something to that before you go to the next
certainly.
slide? Because for those of you who are watching this slide is real impactful, especially if you are a self-directed IRA investor. So I just want to point out some things because we're going to actually cover a little bit at the end here, but I don't want to miss this point for you self-directed IRA investors is, you know, when Jane's talking about diversification, you know, a great way to diversify even within your own self-directed IRAs is to have multiple self-directed IRAs or other accounts that are tax advantaged, like your HSA, your health savings account, ESAs for your children. And we'll talk about this. And the reason why I want to bring that up is because when I do a note, because I'm a note investor as well, I don't just use my Roth for a note or just use my HSA. The lender on my notes are partnered between my Roth, my HSA, my niece's Coverdale's, because that allows me to diversify by more notes in case, one's, is worse than the others, but I'm spreading out even my self-directed IRA wealth amongst different notes. So we'll touch on that at the end about the different types of accounts you can use. And then that power of compounding is a phenomenal way to grow true wealth and completely tax-free, is by compounding your earnings, by taking your interest and reinvesting it. And notes is a great way to do that. So just wanted to add on to that, Jane. Great points.
Okay, so yeah, and I do have a slide to show the compound impact on your self-directed IRA in the separate slide as well. So
awesome.
Here we go. The great thing about notes is that it's predictable, right? So, when people invest in digital currency, Bitcoin or stock market, is very unpredictable. You could go up 20% today and go down 30% tomorrow. But notes is very predictable. So if you sign a contract, you purchase a note, and then the note is going to generate you 8.5% annual interest, you will get that, right? That's the minimum you will be getting. If the borrower pays you off early, then that will increase your return. So you're pretty much guaranteed for the yield that you put down. And then it's very consistent. So I wanted to use a simple example here, right? We invest $100,000 in your self-directed IRA account. We earn 8.5% annual interest rate. And by the end of the year, we compound that. We use what we earned, we invest in more in notes. What's that going to do for us? I have a little chart here. And you can see the increases more slowly at the beginning, but it just grows very fast at the end. So $100,000, 15 years later, it's going to become almost $340,000, right? If you compound every year. And so that means your $100,000 in the 15 years, you can earn about $240,000. That's great for our IRA investors because you don't have to pay taxes while you are investing for that 15 years. It'll just continue to grow your money. So this next thing, what we want to talk about is, okay, I'm ready. I love notes and I'm ready to do a note transaction. And what are the steps we're going to take to purchase a note? So there's mainly three parts, right? There's us, we are the buyer, and then there's the seller, and there's a loan servicer as a third party. When we are using our NewView account to do the purchase, we do need to have our NewView custodian be involved, but their work in the whole process is not a lot, and then they're very professional about what they do. So what the important thing in the whole process is, first of all, we need to be able to locate those notes to purchase. And then the next thing is we need to be able to perform the due diligence. But I separate the due diligence into two parts. One, I call it the initial due diligence. And then the next one is called the remainder of due diligence. The reason I separate the two is because part of the due diligence, there's no money involved. You don't need to spend any money on it, but part of it you will need to spend some money on. So the initial due diligence, when you do that, after you do that, and then you identified it as a good note, you want to bid on it, then you make an indicative offer to the seller. And that offer, when you email the seller about the offer, you put a contingency on it. That's contingent on your title review. Because when you want to run the title report or review the title report, or later on, I will talk about the BPO, those all cost money. So we want to make sure we will be able to purchase the note at the price we want to purchase before we spend any money on it. So you make the indicative offer to the seller, and the seller agree on the price. Then we do the title review and BPO, etc. Everything needs to be done before we sign the PSA, the purchase and sale agreement. Before we sign the PSA, nothing is final. You can always back out from the deal. So once you sign the PSA, the next step is to fund it. So at that time, you will need to complete NewView's investment forms. You will need to submit the PSA, the forms to NewView for funding, and NewView will send the seller the funds to complete the purchase. And the last step you will need to do is send the seller your servicer's information. Which servicer are you going to use? Where do you want to transfer the note to? On the seller's side, they actually, first of all, they need to review your price, whether they will agree on your purchase price. One advice on your purchase price is don't try to lowball the seller. This is a market. If it is a good note, the seller will be able to sell at a market price. If you send the seller a low offer price, you are just going to get ignored. So very recently, we sold a few notes, just to the public, and we sold it about 9 to 9.5% yield, and that's the market price. So if you are trying to lower your offer price, and just nobody's going to look at your offer. So once the seller agree on the selling price, and the next thing is, the seller actually needs to sign the PSA as well. And then you will fund the deal, and then the seller will confirm the receipt of funds. The seller also needs to create something called the AOM at launch. AOM is just assignment of mortgage. They will assign the mortgage to you. Remember, when you are using a NewView account, the new mortgage is going to, the owner of the new mortgage is going to be your NewView account, right? It's going to be NewView Trust FBO John Smith account number XYZ. Once that's done, then the seller should transfer the servicing to your identified servicer, whoever you want to use. And at that point, once the PSA is signed, the funds are received. From that point on, the note is yours. And if after that day, the seller receives any funds from the borrower, they need to send the funds to your new servicer. It's not theirs anymore. So the other thing is, the third part is the servicer, right? The servicer, whoever you are going to use, they need to accept the service. They accept to service your loan from now on. This is not a for sure thing, because you need to provide everything the servicer is asking for. Mostly are the collateral files, the AOM, and then you also need to be recorded. Sometimes the servicer will reject the transfer if you cannot provide all the documents they needed. And then the servicer will notify the borrower. They will send out, your new servicer will send out a letter to the borrower and to inform them the change of servicer. We call it a hello letter. And from then on, the servicer will start sending statements to the borrower every month. And you will have access to the online portal to view your account. It's just like a brokerage account. It'll show all the holdings you have, all the detail about each loan. And you can view it, and you can see when the borrower calls or when the borrower makes a payment. And also the servicer from now on will accept all the payments from the borrower, not you, right? The servicer is going to accept all the payments to their escrow account every month, and then they will forward the payments to your NewView IRA account.
Jane, I want to just pass along a question that's pertinent to that.
Okay.
Good question. It's how or where does one find a servicer for the note?
You can just send an email to me.
There you go. That's why we ask.
I can give you a couple of ones that note investors use quite often. One of them is called the FCI Lender Servicers, and then the other one is called the Land Home, and then there's another one called the Allied. Those are popular ones note investors use.
Yeah, and I'm familiar with all those. And what I would say to the self-directed IRA clients out there, remember when you're self-directing your IRA into different investments, you're the fiduciary to the account. You have a responsibility to make sure it grows. And having a servicer is just one of those things you can put in place to make sure, payments are being, sent in the right directions. If you have trouble with the notes, they'll fill in and take that responsibility. But and it's case by case. It depends on what you're doing. I'll just say for my example, I'm not buying pools of notes, but I might do individual notes, and I may quote service them myself. Now, I'm not servicing them to the degree that Jane's talking about, but if I ever run into an issue, then I have to get a professional, like an attorney that might have to do the foreclosure and things like that if I get into trouble. So it really just depends on to the level of what you're doing when you're buying notes. I would say that the more active note investors, the ones that are really buying a lot of notes and doing this more frequently, definitely have a servicer. So it's really up to you. But like you said, if you have questions about how and where, and if it fits your style of investment, then Jane's definitely someone you could reach out to.
Yep. All right. So now we talked about a little bit about the due diligence process. I want to dive into more details about the due diligence process, because this is a very crucial part of the whole note purchase process. Once you get it bought and then it's in your IRA account and the borrower is paying, then you are done, right? You just watch the payments come in every month. But the purchase process, the due diligence process, that's almost 90% of the whole, all the work you will have be involved. So there are major things. In my previous slide, I mentioned when you do the due diligence, you kind of separate them into the two parts, right? Free part and the cost money part. There are three major things that in this due diligence process. One is the property related items, and then the collateral, the note, the mortgage specific items, or as part of it is the borrower specific items, and then the servicing part of the due diligence. So before we sign the PSA, or I should say, before we send a bid to the seller, what are the things we need to do? On the property side, what we need to do is verify the fair market value of the property. We normally use multiple sources, right? Most people are familiar with Zillow, Redfin, Realty Track, Trulia. You can run multiple sites and to compare, each other's price, because some site may value a property higher or may have, there's variables in it. It's not always that scientific. So you want to be conservative. You want to see how each site is viewing the fair market value of the property. So once you get that determined, all the other things I have on the, on my list, that will be something we'll do a little bit later. So the next thing you need to do is review the collateral files, the note, the mortgage, the terms, If the loan was modified before, what's the modification? You want to get a copy of the modified loan, because that's basically your new loan. It's not the original loan anymore, right? That's what the borrower will pay based on. The payment status, what's the payment history, and how much down payment the borrower has made. And also ask for a credit report from the seller about the borrower. One thing we do check is called the PACER. PACER is a government-run website. It's to get any bankruptcy records. So you can, as long as you have the borrower's social security number, you will be able to go to PACER, go to this website, and to see if the borrower has had any bankruptcy filings in the past. This is important because I don't want you to be confused, but although bankruptcy information is important, but do keep in mind, our loan is secured by the property, not by the borrower, right? So even if the borrower has had a bankruptcy record, that doesn't mean we cannot buy the loan. We can still buy it. But what we don't want to get involved are the loans that the borrowers continue to file for bankruptcy. So that's just going to add more work for future transactions. So we try to avoid that. And the other thing we need to verify is the outstanding unpaid principal balance. This is something it's pretty easy to be verified, because if the current seller, they're using a servicer, on this servicer's payoff report in my next category, it'll show what is the current unpaid principal balance. Right, on the servicing side, you will get the payoff, the loan payoff report from the loan servicer, and you will also be able to review. This is important. Review the servicing comments, right? Especially if it's a reperforming note, you want to see has the borrower had any issue in the past 6-12 months that they're making payments. Because the loan servicer, they are required to make a record of any communications they've had with the borrower. So you would be able to kind of get evidence or review, see if there's any issues with the borrower. So once you are done with all of that and you determined this is a good note and you want to make a bid on the note, then you send in your bidding price. It looks like we have a lot of steps, a lot of things to review, but you actually have to do everything in a very short time. The note industry is a very fast industry as far as purchasing. I give you an example that recently we sold a few notes. The whole process is just within a week. So I had the information out on Monday, and the next Monday we were already being funded. So that just means that when you see an opportunity, you need to focus on it and do all your work very fast but thoroughly. So you make a bid. After you make a bid, some of the things I would encourage you to do, and I think it's very important. The first thing is the title report, title review. So you can ask the seller to provide you a title report. Sometimes the seller doesn't have a current title report, so you would have to run it yourself. And then there is a lot of different companies, they offer that service. So once you run the title report, you will review the title report and to see if your lien is actually first lien, if there's any other liens such as HOA lien or property tax, if everything is current. If there are other liens above you, and if you're buying a second lien, and then you can also verify about the first lien as well. So the title review, I think it's very crucial in the whole process. If you are new to no investing, you are unsure about what you're doing, you can always use an attorney to do the title review. And if you don't have, the attorney needs to be licensed in that particular state. If you don't have one, you can always email me, say I need an attorney, I can send you someone. When the loan amount is large, and the other thing we do is we would run a BPO as a broker price opinion. So what this helps is the person that does this BPO report actually has to drive by the property to see the surroundings and the outside condition of the property. That's very helpful. But they cannot go into the property because you are not the owner. Even the seller is not the owner of the property. So we can only see from outside, but that will give you a pretty good idea about, the value of the property. That's much better than you just get a property value from the website. But a BPO report or title review, those all cost money. So unless the seller has agreed on your price, I wouldn't go to run the reports and to spend money on those items. So I have a little example here, like the due diligence I talked about before, and in the real case, what do we do? And I also I'm also going to show you sometimes we do go off the criteria we have for ourselves, and how do we compensate that if that's the case, right? So this is a property in Michigan. It's a real property. It's a real note. The fair market value of the property was $138,000. This is the picture of the property. So when we talk about fair market value, I always tell people you cannot set a dollar amount, say, this is the kind of fair market value I want all my notes to have, and that's not realistic because a property in Michigan and the property in California, that's very different. $138,000 in Michigan, you look at the house, it's decent. $138,000 in Southern California, I don't know if you can get anything. So the location of the property, determines the value, and so that's for different location, different states, different cities, you need to have different standards for what kind of loan you want to purchase. So for this particular property, we had there was a first lien, first mortgage on this property. It was $60,000, and we purchased the second lien, and the second lien was at $57,000. So if you add the two together, the CLTV, the combined loan to value, is 85%. That's already above the standard I said was 80%, right? So how do we compensate that? How do we make it, more secure when we make a purchase like that? We discount it, right? Well, if anything, it's more than 80% CLTV, then we need to discount it further. That's what we did. And then, as you can see, we purchased it for $40,000. And that's about 70% of the UPB. And that brings the total combined loan to value to about 72%. So we review the borrowers, the credit, their financial condition, and we determined this borrower, that they are an older couple. They live on fixed income. And the monthly payment for our lien is about $300 per month, right? It's within their financial condition. It's affordable for them. So we purchased this note at 14% yield. That's just, that's the price we purchased. Again, part of the reason is the COTV is slightly higher than what we like to purchase. So we run their bankruptcy record. There is no bankruptcy in their record, so that's good. We run the loan servicer notes, and there's no notes, so the borrower has not had any issues. So everything checks out, and we make the purchase. And if you are using your self-directed IRA account, you simply transfer that to title into your New View IRA, FBO, John Smith. As our individual note investors, what should we do? A lot of investors will ask me, should we buy individual notes, or should we invest in the managed fund? As Nate said before, he buys notes, right? So that's one way to invest. And then some people invest in the managed fund, a note fund. There are different note funds out there. You can definitely compare them and decide which one you want to invest. There's no right or wrong as far as you buy individual notes, or you participate in a fund. There's advantages and the disadvantages for each investment method. When you buy a whole note, the advantage is, as many of our investors are very sophisticated. And if you you have the time, and you have the experience, and you know how to perform the due diligence, and you have the ability to find the notes to purchase, then you will be able to select the notes you really want to buy. You handpick each note you purchase. And the other advantage is, if the borrower makes early payoff, as I analyzed it before, you will be able to benefit from the early payoff, right? If originally the yield is 8.5%, if the borrower pays off early, you will be able to benefit from the early payoff returns. And as a lot of us like to learn and like to do the investing on our own, and this definitely will give you all the hands-on and learning experience. The disadvantage is that you will have quite a bit money tied into one asset. So it's most of the time you are not going to be very diversified, unless you have quite a lot of money and you can buy many notes at the same time. So when you start out, you may not be able to diversify. And if the borrower goes sideways, stop paying, then you will have to coordinate the foreclosure process. If you don't know how to do that, then I would say you need to learn how to do that before you make the purchase of a single note. And you also need to spend a little bit of time monitor the servicer and the communications they have, if that's needed. When if you decide to invest in a note fund, and the advantage of doing that is definitely diversified. As I mentioned before, a note fund like ours is not a big fund, and then there are very large note funds out there, and they probably have thousands of notes in the fund. But even for us, for a small note fund, we're very diversified. We have hundreds of notes. And as an investor, you don't need to monitor the servicer. You don't need to deal with foreclosure. You do have a team of full-time professionals. They manage the fund and manage your money for you. The return from, when you invest in the fund or when you invest in the single note, it's going to be not too much off, right? So like I said before, if you are investing in the single note right now, the market rate is probably around 9 to 9.5% yield. In a note fund, you will get similar. I see very often the note funds run somewhere between 6 to 9% return for you. So you just have to choose which one meets your requirement. The disadvantage of being in the note fund is you cannot pick a note, right? The notes are picked by the managers that manage the fund, and you don't actively manage the assets. Again, the managers are managing the fund. I talked about, in the previous slides already, just very briefly to kind of summarize what I talked about by using your NewView Trust self-directed IRA account to do the note purchase. The normal purchase process, you sign the PSA, you submit your PSA and your funding direction to NewView. And you need to title the mortgage into your IRA account, and you sign it, and you give all the documents to NewView along with funding instructions. Every year you do need to get a fair market valuation. That can be done fairly easily. Most of the time there's no U-bid involved since you are not using leverage. But if I don't know each individual's particular situation you are in, so I would always recommend you to check with your CPA and your IRA custodian to determine that. Okay, so that's all for me for today. And as I promised before, we have, Josh Andrews has a book that's being published in 2017. It's called Paper Profits. So I have a link here if you just want to get a free book from us. We mail the books to you, and there are physical books. There are not a digital book. So, you can make notes. Some of our investors like to make notes on the books. And then also I have our contact information here. If any of the things, you need help with, whether it's you need an attorney or you need, you want to know where to find notes, you can always email me at jane@paperprofitsinvestors.com. It's a little bit long. Or send me a text, and I will definitely get back to you. One thing I do want to mention before I'm done is that I host a weekly note investing webinar. It's free and it's via Zoom. So if you just want to learn more and you love notes and you wanted to learn more about how to do note investing, you can join us every Wednesday. It's at 4:30 p.m. Eastern time. All right, Nate, that's it for me.
All right, Jane, thank you. And I'm going to finish up with a couple slides as well to play off what you presented. And I will answer some of the questions that I've already read that have to do with IRAs. And I noticed that there were some questions for Jane as well. So just stick tight real quick. And just remember, what Jane presented is really, really good information about what one would do to make sure that they are, eliminating as much risk as possible when buying notes. So remember, investing is not a risk-free activity. There's always risks involved in whatever investment you make. The way to stub your toe less in the long run is to do proper due diligence and know what your exit strategies are or what your tasks are, in the event things go wrong. But due diligence will prevent that. And why would you use an IRA to buy notes other than personally? First of all, I think you should buy notes if it's something that you understand. I think you should buy it personally and in an IRA. There's nothing saying, and I've seen this online, sometimes people say, I'd rather buy notes personally than in an IRA or vice versa. It really depends. If you are trying to save for retirement, IRAs are a great way to do that because it's a tax advantaged account that's treated better when it comes to taxation than us as an individual. So I would ask, well, what do you get invested in? You have to invest in something. I find notes to be a great investment because I come from a lending background. I started off in the mortgage industry, but outside of that, it's really an investment that's very passive for me. I can sit back and watch the income come in on a monthly basis from my borrower. I don't have to turn on CNBC to see, what the value of my retirement account is at that time. And I know at the end of the day, I can sleep at night because my money is secured by something tangible. And that tangible asset is real estate, which is the largest segment of our economy, and it's not going anywhere. So I think if you look at an airplane view, notes are a great thing. It's a paper asset, but it's secured by one of the greatest assets, on earth, which is real estate. And using an IRA to hold those investments gives you the opportunity to grow true tax-free wealth. And depending on the type of IRA you have, even compound your interest in a tax-free manner. So when you're thinking about buying notes, buying real estate, buying whatever, think about the plans you can use to shelter taxation or eliminate taxation altogether. There's 7 types of plans that we have just here in Newview. A lot of people are familiar with the traditional Roth IRA. That's where 70% of America's retirement is held when you're talking about IRAs, which make up about $10 trillion of American retirement wealth. If you look at all retirement wealth, when you include 401ks, 403bs, it's upwards of $35 trillion. But only about 2%, 3% of people actually self-direct their retirement accounts. But these would be the accounts at Newview that you can use to buy notes. And I kind of mentioned earlier, I've got different types of accounts. For instance, I am a big fan of the Roth IRA. Not to say the traditional IRA doesn't have its benefits, but for my investment strategy, I'm buying notes, I'm creating notes, which is just a little bit different, but it's still a note. The underlying investment's a note, but I'm creating a note where I've already established who my borrower is going to be. And typically that's going to be a real estate investor, but I do short-term notes. It's a 1-year note with an optional extension. And I know that I'm going to get my principal and interest back after 1 year. And then I can compound that by doing another note after that one's paid off. I know I'm secured by real estate. And if I'm going to compound my interest, I'd rather do that in a tax-free manner versus a taxable manner. That's why I like the Roth IRA. If you're self-employed, you can also buy notes in a SEP IRA, a simple IRA, or even your own solo 401k if you're self-employed. Our solo 401ks also have a Roth component to them. So that would be another great tax advantaged account that you can use to grow tax-free wealth is through a Roth solo 401k. And the other plans that I like to use are the health savings plan, which almost nobody talks about, and the education savings plan, which is the CISA, Coverdell Education Savings Account. These are accounts that work a little differently than the retirement accounts it previously mentioned. The health savings account is a savings account that a lot of people have set up by their employer. I'm shocked to hear how many people just have their health savings account sitting in cash and not knowing they can actually invest that money. You can buy notes, you can partner your health savings account with your Roth IRA. That's actually what I like to do because it gets multiple tax advantage buckets working at the same time. But here's the beauty part about the health savings account is that when I make contributions to the health savings account, anytime I put money in annually, I get a tax deduction. And then as it grows, I can decide to take money out to pay for out-of-pocket qualified health expenses, and it's completely tax-free. So I can use the money earned from my notes, the portion of the profit that's going to my health savings account. I don't have to wait for retirement to use that. I can use that today for any out-of-pocket health expenses that my insurance might not cover. That would be doctor's visits, acupuncture, holistic medicine. I mean, there's a long list of health expenses that can be paid out of the earnings if you have health savings accounts invested in things like notes. The other cool thing with the health savings account, and I'll do a class on this specifically because I have no life and I'm just a big IRA nerd. So I like talking about health savings accounts, but it's one of the accounts that you can actually, it's not like a flexible spending account where you have to use the money before the end of the year or you lose it. The health savings account, you can keep the capital in there and keep investing it, keep compounding it, and just reimburse yourself later down the road to pay for expenses, health expenses you paid in the past. It's a phenomenal tool that not many people think about when they're investing in notes. So even current clients, if you have a Roth IRA, a traditional IRA with us, look at this and say, does a health savings account meet my needs? Do I have kids or grandkids that an education savings account meets my needs? So you can even partner education savings accounts where the benefit to the profit of, if it's invested in a note, you get interest payments from the borrower, you can take those profits out and pay for qualified education expenses for your kids or your grandkids. And it's not just for college, it's for expenses pre-K all the way through college. I noticed somebody had mentioned, can I buy partial notes? Partial notes is a great investment strategy. I've seen people buy partials. Reason why someone might buy a partial is maybe they don't have quite enough capital in their accounts, and this would apply to health savings accounts and education savings accounts, because oftentimes those accounts are a little bit smaller. Sometimes partial notes might be a good avenue to get those buckets invested and get them rolling and get that growth compounding. So when you look at this, you should be thinking to yourself, I want as many of these accounts as possible. Me and Jane were talking before it started, and you mentioned the same thing. You mentioned, without even bringing this up, you had mentioned, yeah, you should have as many as you can find, right?
Yes.
Yeah. So again, think about that as a client or non-client. How can you maximize your tax-free growth? And if it's in notes, it's a great way to eliminate the taxes that you pay over your lifetime. When it comes to investing in notes inside or outside of the IRA, I say, if it makes sense and if you're knowledgeable about it and you're doing your due diligence, why not do both? But always ask yourself, if I have a retirement account, what am I going to invest it in? Invest in what you're knowledgeable about. And notes is one of those things that's, pretty easy for most people to understand. And if you don't quite understand it, that's why we have people like Jane on that can be resources to you to help you understand it, or at least give you the resources to help you become a better note investor. I like to end with this. This is a quote that I took off of a Forbes article back in March of 2020. When they looked at IRAs in general as a whole, and this was a study that was done and Forbes reported on it, they reported that only 2% of all IRAs held alternative assets. And when we're talking about notes, we're talking about an alternative asset. These notes are not investments that you will find at Fidelity, at Charles Schwab, at TD Ameritrade. They don't sell notes as an investment. They don't make money on that. So most people don't even realize that they can hold alternative assets in an IRA held at NewView. So only 2% of IRAs hold alternative assets. But the interesting thing about the article is when they look at the IRAs valued above $5 million, 25% of the assets held within all those accounts were alternative assets. That tells you something right there. That should speak loudly to you guys out there that the rich and the wealthy are already keen to the value alternative assets play in an overall investment portfolio. You don't have to be a note investor. You don't have to be a real estate investor for it to make sense to hold real estate or notes in a retirement portfolio. Jane kind of brought it up. A lot of the benefits have to do with it being tangible, the multiple income streams that can be gained, the fact that you can compound the interest. And here's one thing that I like to talk about is that a lot of times these investments that we hold here are socially conscious investments, meaning if you're buying, performing or non-performing notes from a bank, and you're having, the ability to rehab these notes and maybe put a borrower into a situation where they can actually pay the note off. That's a social good, I think, that you're using your retirement account to do. So not only are you able to make money on your retirement investments, but you're also providing a good, and you can kind of target where you want your money to be invested in. For instance, I do notes in my community where I live, because I know at the end of the day, if I'm doing a loan to a borrower who's flipping a property, not only is that real estate investor, able to buy a property that's an eyesore in the neighborhood, but they're putting contractors to work, who are putting subcontractors to work. There's so many other good things that happen through the use of my money in my retirement account, other than me just making a profit. But remember, using a self-directed IRA is a great way to build true wealth. And I want to thank Jane, and we're going to get to questions here in a second. I know there's a lot of questions for Jane. Can you pull up the questions for me, Grace? And I know there's one here, there's a couple that were repetitive. So one of the first ones, I'll take this first one, Jane, is a lot of people said, can I actually service notes within my IRA? There was another statement that said, don't you have to use a servicer to be compliant when you held notes in an IRA? And I'll give you the answer most attorneys would give. It depends. So when you look at the IRA rules, there is nothing in the IRS code that says you have to have a servicer for note investments. It's not that specific in the code. Mm-hmm. What the IRS states that you have to just be aware of, but not scared of, is that remember your relationship between yourself and your IRA. You're the fiduciary to your IRA, which means you have to act in the best interest of your IRA, not in the best interest of yourself. Okay. So what that means is your IRA is not going to do things on its own. It's not going to find its own investment. That's your job. Your job as the IRA owner is to find it investments. Jane showed you a lot of ways that can help you maybe cross that bridge or bridge that gap to find investments. But when it comes to servicing the loan, again, it depends on whether or not you are being too active, or what the IRS would call extending a service to your IRA. Be cautious. First of all, this term is not defined in IRS code. It literally says extension of service by a fiduciary to their IRA is prohibited, but they don't define what extension of a service is. And when you look at case law, when you read between the lines, really what it comes down to is, are you using your brain as a fiduciary, or are you using your brawn? I'll give you an example outside of notes that is a little easier to understand. If I use my IRA to buy a rental property, I can pick the rental property my IRA owns, that's using my brain. I can pick the renters that rent that property, that's using my brain. I can pick the contractors that fix the property up, that's using my brain. I cannot be the contractor swinging the hammer and putting the fourth bedroom addition on myself, because that's an extension of a service. That's pretty clear cut. Where would servicing alone fit in that equation? It's hard to tell. I'll give you an example from my own personal, is that when I'm creating notes, I don't have a servicer. Okay? It doesn't make it me right or wrong, but I'm doing one note at a time. I'm doing it with borrowers I have a relationship with. I'm still having an attorney draft the note and the deed of trust. I'm closing at a title company, so I'm not involved in that. And in the event my borrower didn't pay, my attorney, that same attorney, would take over in the foreclosure process. So in that scenario, I don't necessarily need a servicer. I'm also not the one collecting the money. The money is going, the interest payments are going directly from the borrower straight to NewView. So that, in that sense, I'm not servicing anything. I just picked an investment and I made sure that professionals, prepared the documents. Now, some people would say, well, what if I want to make sure that my borrower pays? Can I collect the check and then send it to NewView? I'd be real cautious about that. If you definitely don't want to do this, you definitely don't want payments going into your bank account and then you try to send that to NewView, because that is not something you can do. You can't commingle funds or take any of the profits from your IRA as your own profits. It has to go, checks have to be made payable to your IRA, whether you collect that and it's still made payable to us and you forward it. I wouldn't do it that way. But again, if the check is made payable to your IRA, is that really considered servicing? Again, I probably think the IRS is busy doing other things other than trying to call that an extension of a service. So, but if you're on a larger scale, I'll tell you this, most of the investors I know that hold multiple notes at one time, and Jane would probably agree with me on this, because they're buying pools of notes. When you're in that game, you're probably going to want a servicer. You're probably going to want somebody that's managing all those notes at once. So the answer is, it depends whether or not how active you need to be. If you're just an investor like me that's doing one note at a time and the payments are just going straight to NewView, I don't need a servicer. But if you are, buying large pools of notes and things like that, you might want a servicer for the ease of use, but be careful that what you do is not considered an extension of a service. I hope that answered that question. But if you want to dig deeper into that, you can always consult with an attorney. Let me see if I've got some questions for you, Jane. Let me see here. Well, we got a lot of questions that came in. Let me see if I can pick one best. Let me do this. What are problems that you could encounter that would make you pass on buying a note? That's a good question. Or should you be aware of a new investor? The second part of that question is, after purchasing a note, what other expenses might you have?
Okay. So the first question is what problems that the note has we may pass on the note, right?
Yeah. Yes.
This mostly happens in almost everything happened during the due diligence, and we pass on a lot of notes. So and a lot of times it doesn't meet our purchase criteria. For instance, if the property value is too low, we normally purchase the notes that the property values are above 150,000. But as I mentioned before, it depends on the location of the property. So if it's a property that's in California, in Southern California, in Orange County, anything probably below $500,000, we will not purchase. So that's, the property value has a lot to do with it. And then the other thing is the title report, right? The title review. When you review the title, especially if a property that has other liens on, because like the property tax lien, or most of the states, the HOA liens, those are above our mortgage liens. So if those liens, you see those liens and you are uncertain, and that, we may pass on those notes as well. The other thing is the BPO. If you go have a broker and go pass by and the property and review the property, and the BPO came back, because they will send you the comps and then they will also send you pictures. And if they don't look good, you may not want to buy, because the outside of the property can tell you a lot about the inside of the property. If the borrower never maintains the yard, and everything is, the roof is collapsing, and you don't want to buy a property or a note like that. So it's everything we do during the due diligence process, any step could make us stay away from the note.
Awesome. Yeah.
The second question is, what are the expenses that will be involved when you purchase a note, or after you purchase the note? After you purchase the note, if it's a performing loan, that's what we're talking about today. The main expense is the servicer. The servicer, if you are using a servicer, if you're not, that you don't have to pay that. But if you do use a servicer, they're fairly inexpensive, I have to say. It's normally somewhere around $15 to $30 per month. But that's something you need to consider, as part of the cost. If the payment every month is only $100 and $15, that's 15% of the total payment. So that will be pretty big. So depends on the size of the note, and the servicing cost could be much, a big portion of it. The other thing is, if you are just like a regular business, if you are using CPA accountants to do your books and stuff, and that's just something you will spend on as well. But really not much expenses that will be involved after you purchase a note.
Here's some other questions for you, Jane. This is from Sherry. She's got a couple questions for you and a couple questions that I'll take. Her first question is, and I know the answer, but I'll let you answer this. Will the lender servicer be put on the homeowner's insurance policy?
Yes, the lender will be in the homeowners.
And what happens if the borrower dies before paying the note off? If it goes through, does it go through probate? Do you sometimes have to settle for less than the unpaid principal balance and wait a long time to even get the money? What, in your experience, can you answer that?
If the borrower dies, yes, the borrower stop paying and the note becomes non-performing. So a lot of things can happen, right? You may end up settling the note with less value, but you don't have to, because whatever the borrower's owed, that's what you are entitled to. But if the property value cannot cover your loan, then you end up settling for less. So that's just if the borrower dies, you have to treat it as a non-performing note, right? Unless the heirs continue to pay. If the heirs continue to pay, then there's no problem at all. If the heirs do not pay, you will treat it as a non-performing note, and anything could happen.
And Sherry asked a question that I've seen a couple people ask, and I'll take this one, is can you explain the use of leverage and how that would relate to UBIT, unrelated business income tax? So in the IRA world, when we're talking about leverage, we're actually talking about owning property that has debt. When we're talking about notes are not the ownership of property. Owning a note, you don't have leverage. Even if you own a second lien position, that first lien position isn't considered leverage. So one of the beautiful things about note investing is that you don't incur UBIT because it's not a debt leveraged investment. The other portion of UBIT that really doesn't apply here, some sticklers might throw this out there, and I'm just telling you this again, not to be scared of, because truthfully, it's just not going to happen, is whether or not you're running a business within your IRA. This is not, owning notes is not running a business, just like owning stocks is not owning a business. Owning a business inside your IRA where you would have to worry about UBIT is if your business is for instance, competing business with somebody else, like you have a pizza shop owned by your IRA that's in competition with other pizza shops. So owning a business like that could incur unrelated business income tax, but buying and selling notes is not going to incur UBIT unless you are perceived as running a note business through your IRA, which you got to be doing a lot more than just buying notes here or there to ever even think about that being an issue. But it is a good question. We get that a lot. But typically you don't have to worry about, for sure, the leverage part, because leverage is not, when we're talking leverage in an IRA, we're talking about owning the property and having debt against the property our IRA owns, which is not what we're talking about here. And then Sherry also asked, where would you find short-term notes? Maybe you have an answer for this, Jane, I'm not sure, but when I'm talking about a 1-year note, you got to remember there's different ways that you can buy notes or create notes. Buying notes is buying existing notes. That is what Jane is talking about, and that can be done in a variety of different ways. And it really just depends as to what the terms of those notes are and who you're buying them from, as to how long those notes are for, what the maturity notes are. When I'm creating a note, it's more between me and an individual where I'm going to agree to loan them money to buy a property. Now, in that scenario, we're creating a note. We're not buying an existing note, we're creating a note. And the terms on that note are up to me to decide with my borrower. So also in relation to that question, I'll let you tag onto this, Jane, is somebody mentioned the 14% annual return or something to that effect. Is that common? I will tell you, in the IRA world, when we're talking about interest rates, on loans, usually a lot of the loans, at least the creation of loans are anywhere between 8 and 14%. It really just depends. Because you got to think, you got to imagine what if you have borrowers out there that are borrowing money, what are their options? They can borrow money from a traditional bank. You're going to get decent rates with the traditional bank, but what else are you going to cut? What else is going to come with headaches by going through the underwriting process, 45-day close, tax returns, you got to submit all that, or you can go hard money, which is going to be upwards of 18%. When I'm doing a loan or creating a loan, it's considered private money. So private money is right in between. And I've seen return, very, very solid returns upwards of, double digits on an annual basis. Jane, I'll let you kind of play on that as well. What do you see? What's your answer on that when it comes to returns?
So I kind of mentioned in my presentation, so what I see typical right now, but it's a market, right? So the rates do go up and down because, like Nate said before, if the borrower can get loans from a bank at 3% and they're not going to take anything more than that, right? When they cannot get the lower rates from the bank, then they have other private lenders out there that they will offer different prices. And so, you're competing with others. And so very recently, when we sold some reperforming loans, they were about 9% yield. So that's from when I talk to other note investors, that's pretty much how the market is now. Will it change? Of course. But when I said we purchased at the yield of 14%, and again, because the note has some, like I said, the CLTV was lower, it was higher than what we want, and then we would discount that. And also, we do have, very long-term relationships with some of the sellers and some other funds, and we buy in pools, so we will have some, pricing advantage when we make a purchase. So it's not typical.
Awesome. And then I'm going to end with one question. What I will say, because we've got a lot of good questions. If you guys have questions that I haven't either addressed specifically, or you just think you want me to expand on it, just feel free to email me at info@newviewtrust.com. Send me an email there. I'll get back to you guys as soon as I can with answers. Try to keep it IRA specific if you can. And if you have questions regarding notes or the information that Jane presented, reach out to her, because she's a great, great resource. She's been doing this for a long time. She's, I enjoy anybody that likes self-directed IRAs, but she comes from the CPA world, so she understands how valuable these self-directed IRAs are, and the tax savings and growth you can make, buying notes or buying whatever investment that you want. And it was just great talking with her. And I really want to thank you for your time, Jane. I'm going to go on to the next slide here and just kind of wrap it up. And again, if you guys have questions that I didn't address, just email me at info@newviewtrust.com, and you've got Jane's email as well. And I will say one last step in this process is we have actually a special promo. So for anybody who has taken the time to watch this great presentation, anybody that watches the replay, I will encourage everybody to reach out to New View Trust Company at that same email, info@newviewtrust.com. And we are going to waive the account opening fees for any accounts you want to open through the end of the month. So May 31st, 2021 here, you can open as many self-directed IRAs as you want, and we'll waive the account opening fee, and that's $50 per account. So if you want to open a Roth, an HSA, a Roth for your spouse, ESAs for the kids, it can save you quite a bit of money. And the trade-off here, again, is if you've spent the time to watch this education, I feel more confident in you as a potential client, because we are only as good as our clients are as investors. The more education you get, the better investor you are, the better relationship that you have with New View Trust Company. And that's really our goal here at New View, is to educate the general public and just make them better investors without actually selling them investments. So Jane, any final words, any closing thoughts you want to give to our viewers?
The only thing I want to say is if there's any other no investing topics you want us to cover with NewView, do reach out to Nate. I will be happy to come back and talk more about different things.
Awesome. Yeah, we would love to have you back because I think just based on the questions alone, there is a lot we can add to this and dive in. So we'll be reaching out to you and getting maybe a series of education with you because it was great having you. And again, thank you to you listeners. Remember, we go live every Wednesday for our Wednesday webinar. Follow us on Facebook if you want to get the actual notifications for when we go live, if you forget. And also subscribe to our YouTube channel where we'll polish these videos up, add some animations and put them on our YouTube channel. Again, it's all about providing you guys great education. And there is our contact information. If you want to talk to one of my IRA specialists, you can call us at 407-708-1853 or shoot us an email at info@newviewtrust.com for any self-directed IRA information or questions that you may have. So for Jane and okay.
Nate, one last thing is that I see a lot of viewers who are asking if you will have a recording. I think the answer is yes. And
yes, the answer is yeah, the answer is yes. And thank you for reminding me, Jane. Anybody that has registered for this webinar will get a recording. When is that, Grace? About a week, right? So I'm looking at Grace here because it makes her really uncomfortable when I look at her. So, but Grace is the one behind the scenes that makes all this magic happen. And she actually is the one that makes sure that these things go smoothly and make sure that you guys get a recording of the webinar. So when you get it, make sure you thank her. So everybody will get a copy of the recording. And if you miss it, or if you're just tuning in and you didn't register, you can always watch the recording on our Facebook channel or keep tuned in for our YouTube channel as well. So signing off. Thank you guys. Have a great rest of your Wednesday. And thank you, Jane.
All right.